The high-yielding Altria Group stock ticker MO, has been on an absolute tear over the last year. It's currently up about 30%, and if we look at this stock on a total return basis, including those dividend payments, it's up about 39% now in the last year compared to the S&P 500, currently around 16.35%. Now, if you've been keeping up with Altria stock over the last 3 or so years, sentiment around this stock has completely changed. From around June of 2022 through maybe February of 2024, the stock really didn't go anywhere. People seem to be convinced that this stock was for sure a yield trap. At the time, it was yielding over 9%. But I think those who actually dug into the company and looked around to see what was actually going on realized this was a massive opportunity at these prices. And this is a stock I've held in my portfolio for a little while now, and if we look at my returns, I'm currently up around 72-73% on this position. So in this video, we need to talk about how I realized this was a massive opportunity in this price range when everyone else was screaming dividend trap. We need to talk about the fact they recently released their latest quarter's earnings, and of course, we want to analyze the dividend sustainability for the stock. Now to start, if we go ahead and jump over to our dividend breakdown sheet and look at Altria, and you can see when I plug in the ticker, all this data will automatically load in. Now, like always, if you'd like to be able to download any of these spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Again, ticker data is how I import the stock financials and also how I do things like track my portfolio with the sheet that you see here. Now for Altria, right now we can see the starting dividend yield is above 6%. That's a pretty high starting dividend yield, but one of the things that typically happens is people look right here at this free cash flow payout ratio sitting close to 80%. Now, we have to remember, a company can't sustainably pay out more in dividends than they generate in free cash flow over the long term. And using 80% of your free cash flow to actually pay out dividends is pretty high. So is this a red flag? Is this something to be concerned about? Well, it depends on the company. Each management team has their own capital allocation priorities, which they assess in order to best reward their shareholders. And this is what a lot of people miss when it comes to Altria Group. If you go look at some of their older press releases, for example, this is actually one from 2022, but they state that their long-term objective of a dividend payout ratio target is approximately 80% of our adjusted diluted earnings per share. So when we see things like this 80% payout ratio, this is not a mistake. This is very intentional by the company, by the management team. And along with this, they've also stated they have a new progressive dividend goal that targets mid-single digits dividend per share growth annually. So the management team is actually giving us a lot of valuable information. They state exactly what their payout ratio goals are. They state what their dividend growth goals are. And what we can see on this page is they're achieving those goals. The payout ratio is right where they want it. And actually, if we look at it charted out over time, we can see it's continued to stay right around that 80% range that they've been targeting. They've been doing this very well. On top of this, the 5-year dividend CAGR is about 3.71%, again, right in line with their stated goals. And this is possible because they're continuing to grow their free cash flow year over year at a low but a healthy rate, at a sustainable rate. This company is a dividend king with over 50 consecutive years of dividend increases. I'm a huge believer in the numbers telling the story of a stock. And Altria is a great example of analyzing these numbers and seeing they are directly in line with what management has been guiding us towards. So we've touched on the dividend a little bit. Let's talk about this recent quarter's earnings report. Altria released their latest quarter's earnings at the end of July, and they announced Q2 non-GAAP EPS of $1.44, which was a beat by around 6 cents, so a decent beat, and then revenue of $6.1 billion, a beat by $910 million, but revenue was actually down by about 1.8% year over year. Okay, let's stop there for a moment. Obviously, declining revenue, not something we ever want to see. But that statistic by itself doesn't paint the full picture for Altria. In fact, let's go ahead and jump over to our profitability sheet and look at MO. Take a close look at the trends of revenue for Altria over the last few years. In 2021, revenue was over $21 billion. We've seen it slowly decline over the last couple of years. Now, on a 5-year basis, we're still seeing a little bit below 1% growth, so still positive growth on a 5-year basis, but yes, slightly declining over the past 2 or 3 years. But here's the key advantage to Altria's business model. They have clear competitive advantages. They have phenomenal pricing power. And this is revealed in 2 ways when we look at the company's fundamentals. To start off, look at the gross profit ratio for Altria over the past decade. What do you notice? Essentially, every single year, the gross profit ratio is increasing. If we look in 2014, The gross profit ratio is around 56%. If we look at what it was by the end of 2024, it was over 70%. So we're talking about close to a 14% increase in the gross profit ratio in just a decade. That's absolutely phenomenal. Their customers are so loyal, they're able to increase their prices like clockwork every single year, and those customers still keep coming back. And as a result, even though revenue has slightly declined, maybe 1 or 2% over the last couple of years, earnings and free cash flow continue to grow higher and higher. Something else that is extremely impressive about Altria is return on invested capital. Again, what are we talking about here? Well, remember, they use 80% of their capital to pay out dividends. What are they doing with the rest of that capital? Well, a portion of it goes to reinvest back into the business. So what type of returns are they getting on that capital? Well, we can see in 2022, 2023, and 2024, return on invested capital was above 30% for Altria. Now, it is important to note it's easier to get high returns on invested capital for a company if they're reinvesting lower portions of their capital. And that is the case for Altria, but this is still a very good sign nonetheless. Now, going back to their earnings report, we have more good news. They did beat on top and bottom lines, but they also revised guidance upwards. And this is typically one of the best things you can see when analyzing an earnings report. If we jump over and look at their Q2 2025 presentation, they stated, "We are raising the lower end of our full year 2025 guidance range and now expect to deliver adjusted diluted EPS in the range of $5.35 to $5.45. This range represents an adjusted diluted EPS growth rate of 3% to 5% from a base of $5.19 in 2024. So yes, they're raising guidance, but the key here is the growth. They're expecting EPS to grow at about 3% to 5%. Why is this so interesting? Well, it's really interesting because we can use this to model out the valuation for Altria. To start off, let's go ahead and jump over to our stock valuation sheet and come up here and plug in MO. There's two valuations in particular that we want to pay attention to with Altria. To start, we'll look at our discounted cash flow analysis and go ahead and zoom in. Now again, the idea behind a DCF model is we're valuing the company based on how much free cash flow they're going to produce in the future. And in order to do that, we need to project how much free cash flow they're going to produce. And to do that, we need to project a growth rate. Now in the scenario, I'm just projecting a free cash flow growth rate of 2.5%, which is actually a little bit below that 3 to 5% earnings growth they're projecting. Now again, I will make note there is a difference in earnings and free cash flow, but typically the growth rates won't be too different. But if we assume a 2.5% earnings growth rate for Altria over the next few years, find the present value of those future free cash flows and add them together. Add the company's cash and cash equivalents, subtract out the total debt to get equity value, and divide by shares outstanding, we come to a DCF price per share of close to about $63. Now, that's very close to the current share price. It's only off by about 5%. Now, let's go ahead and jump over to our dividend discount model. And again, in this scenario, we're valuing the company based on how much they're going to pay out in dividends in the future. And we're assuming a dividend growth rate of just 2.5%. Now again, the caveat to this is I think there's potential for them to grow this at an even faster rate, especially if they're going to be growing earnings in the range of 3 to 5%. But again, I'm not trying to price in a best case scenario. So with a growth rate of 2.5% for the dividends, we can see we'd come to a dividend discount model price per share of about $64.34. Again, very close to that current share price, only off by around 3%. So based on that growth rate of 2.5%, it looks like Altria is trading very close to fair value. It's only off by about 4 to 5%. Now, what if they're able to sustain growth rates that are on the higher end of what the company is projecting? Let's say 4% in the scenario. All of a sudden, the DCF price per share jumps up to about $71.22, and the dividend discount model, if we apply 4%, gets all the way up to about $84.86. And if we average those two together, that'd be a fair value of about $78. All of a sudden, it's pretty easy to see how, with even very low growth rates for Altria, the stock is still trading at an interesting valuation. For example, if we just look at the free cash flow yield for Altria, we can see down here the free cash flow yield is 9.6%. What does this mean? Well, essentially for every $100 we invest into this company, they're going to produce about $9.60 in free cash flow. That's very high. If they're able to continue to grow free cash flow at 2, 3, 4, even 5%, our free cash flow yield on costs is going to continue to climb higher. So throughout this video, you've probably started to realize how even though sentiment was very poor for Altria in that time period of around 2022 through early 2024, everybody was hating on the stock. If you were actually paying attention to what management was stating was their goals, how how they were stating they're expecting low earnings growth and how the dividend would grow at a low rate as well, it started to become pretty clear the stock was severely undervalued, and it's climbed at a high rate since then as a result. For me, I'm perfectly happy continuing to hold my MO position. I haven't added shares in a little while, but when I look at this recent earnings report, when I look at those valuations, it still has me excited to hold this stock. So go ahead and let me know what you think of MO in the comments down below. And like always, if you'd like to be able to download any of these spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.